In this video, we're going to discuss the computation of basic earnings per share. In particular, we're going to focus on calculating the weighted average number of shares outstanding. Recall that we need to include on our income statement presentation a computation of earnings per share, which indicates the amount of income earned by each share of common stock. It's basically net income divided by the weighted average shares outstanding for a company with a simple capital structure and no preferred stock. We'll need to make modifications for this for more complex capital structures. And companies will report earnings per share only for common stock, and they'll do it on the face of the income statement. If the income statement, recall, includes intermediate components such as discontinued operations, companies will need to disclose the earnings per share for each component. So we'll disclose income from continued operations, any gain or loss from discontinued operations net of tax, as well as earnings per share related to bottom line net income. We're going to take a look at two earnings per share calculations. First, earnings per share for a simple capital structure, that is, one that only has common stock and no potentially dilutive securities, and then earnings per share for complex capital structures. And a complex capital structure is one that includes securities that could dilute earnings per share for common shareholders. And dilutive means the ability to influence our earnings per share calculation in a downward direction, which means that we need to reduce the numerator, net income, or increase the denominator, weighted average shares outstanding. Again, we calculate earnings per share for common stockholders or common shares. That means we're going to need to make adjustments if the firm has dividends. We will subtract current year preferred stock dividends from net income to arrive at income available to common shareholders. So our earnings per share calculation becomes net income minus preferred dividends divided by a weighted average number of shares outstanding. It's important to remember that preferred dividends are subtracted on cumulative preferred stock, whether they're declared or not. Now, if the dividends are non-cumulative, we will only subtract the dividends if they are paid. But on cumulative preferred stock, where preferred stockholders have to receive any dividends in arrears before common shareholders receive dividends, we subtract that from the numerator. In calculating our weighted average number of shares outstanding, companies must weight the shares by the fraction of the year that they are outstanding. Usually this is done on a monthly weighted average. And when stock dividends or splits occur, companies will need to restate the shares outstanding before the share dividend or split. In other words, we assume they happened at the beginning of the year. This is because stock dividends and splits, if you recall, don't actually change the total assets or equity of the firm.